Just how much tax do you pay on a Roth conversion in retirement? Hi, this is financial planner Sean Mullaney. Let's discuss. So I'm positing a married couple, both retired, both age 66. And they're living off taxable sales of mutual funds, ETFs, stocks inside a brokerage account. All right, so we start to think about their taxable income, and maybe they could add some Roth conversions, but they'd pay tax on those. So let's just lay the land out here and see maybe should they do some Roth conversions and how much tax would they pay on those, right? So interest income, $2,000. They've got some qualified dividends, $15,000 in my case. I'm positing long-term capital gains about 45. You got to remember, they got to go sell mutual funds to live their life, to fund their lifestyle. And that generates $45,000 of taxable long-term capital gains. Okay, fine. Their adjusted gross income is $62,000. They're over 65, so they get the standard deduction and the additional standard deduction. They're married. And we get them to a place where their preliminary taxable income, if they do nothing else, will be about $30,000. I got $29,700. Okay. At this point, they pay zero federal income tax, right? They don't have to do anything, right? They can report this on a tax return, zero federal income tax due. Thanks so much. We're done. But, a lot of planners, a lot of folks out there are going to say, wait a minute, they should do Roth conversions. And I'm here to say I pretty much agree with that. But let's go into some numbers. All right. So a lot of folks like to say, well, you should do Roth conversions maybe to the top of the 12% bracket, right? Hey, you're in the 10% bracket, 12% bracket. Maybe you should do some Roth conversions and maybe you pay a 10% or 12% tax on those. Well, is that really true? Let's do some numbers here, right? So the top of the 12% bracket is at $94,300. Okay, fine. So if I were, advising a couple like this, I'm not advising you, right? This is an academic theoretical couple. I'd say, you know what you do? You ought to do before year end a Roth conversion and just round down, right? We want to keep you in that 12% bracket. So I'm saying, hey, you know what you ought to do? You ought to do a $60,000 Roth conversion before year end. Okay, that's we're basically trying to get to the top of the 12% bracket, but we're being conservative. We round down. Okay, no big deal there. So this couple's income is now $89,700. That's their taxable income. And you say, well, okay, did they pay a 10% marginal rate or 12% marginal rate on that Roth conversion? Well, how much tax did they pay? They only paid $3,100 on a $60,000 Roth conversion. Oh, that's interesting. And that means their effective rate on the $60,000 Roth conversion wasn't 10%, wasn't 12%. It was only 5.17%. But wait a minute, I thought they were in the 10% or 12% tax bracket. How can it be that they only paid 5 and a little change percent on that Roth conversion? Well, we have to go to the tax computation. I got a little tab here with that. And what you have to remember is there's this phenomenon in American tax called income stacking, right? Taxable income stacking, where the long-term capital gains and the qualified dividends are taxed at the end, right? The first things that are taxed are ordinary income. And in this couple's case, that's interest income of $2,000, and that's the Roth conversion income. So what I do is I lay out the levels, and so that's why I've put interest income. That's at the bottom. That's level one. It's the first thing that's taxed, $2,000. Well, you got to remember, they've got a $29,200 standard deduction. So they effectively pay zero tax on that interest income because the standard deduction is more than sufficient to suck that all up, right? So no tax on our interest income. Okay, but now we got a big, juicy, long-term or the Roth conversion. Okay, well, that's $60,000. Well, first it goes against the remaining standard deduction. In this case, that's $27,200. Then it goes against their additional standard deduction, $3,100. Then it goes against their 10% bracket. The 10% bracket for a married couple is up to $23,200, right? So they still have room left. They actually some of this goes into the 12% bracket, about $6,500 in my example. So that's that's creating $3,100 of federal income tax. But notice, basically half the Roth conversion is tax-free because it goes against the standard deduction and the additional standard deduction. Holy cow! That's why they're only paying a 5.17% effective rate on this Roth conversion. They're cooking with gas because of this income tax stacking phenomenon and the very high standard deduction we have today in federal income tax. And then the last one is, they had all that dividend income, $15,000, the long-term capital gains, $45,000. Well, isn't that going to be taxed? Well, because they kept their income below the top of the 12% bracket, all of that goes tax-free. Holy cow, that is fantastic. So this couple is paying $3,100 in federal income tax, and they moved $60,000 from a taxable account, traditional IRA, say, to a Roth IRA, a permanently tax-free account in their case. Presumably they have the 5 years, and okay, fine. So great tax planning. I think there's two additional notes I want to say here. One is, you might say, well, wait a minute, what if they were an early retiree and they've got a premium tax credit to manage? Well, that's a fair point, right? This might not be as attractive for a couple with a premium tax credit, or maybe they'd want to do less of this. The way I generally look at it is from a planning perspective, when we have a premium tax credit, oftentimes Roth conversions reduce the premium tax credit 10 to 15 cents on the dollar. So it's essentially a 10 to 15% surtax. In this case, let's just say it was a 15% surtax. They're still only at a 20% effective rate. They still might want to do that Roth conversion. They got to do their own analysis, of course. But, a lot of married couples maybe took deductions at 22%, 24%, 32% to get into that Roth IRA, or to get into the traditional retirement account to begin with. So maybe this is still a good move for them, or maybe they just reduce the amount of the Roth conversion. Okay, that's one consideration. Next thing is this. There are plenty of accumulators out there in YouTube watching this, I hope. And the big implication for you is, why are you so enthusiastic about the Roth 401k? Right? Are you going to get to age 66? I hope you do, right? No guarantees, but I certainly hope you do. Maybe age 67, age 68, 69. You're going to have this opportunity, but only if you contribute to traditional retirement accounts. This opportunity does not exist if everything's in the Roth 401k, okay? And why are we foregoing a tax deduction at work today at 22%, 24%, 32%, right, where a lot of working Americans saving for retirement find themselves, to instead of do the Roth 401k, when we might have this Roth conversion opportunity and pay a 5% effective rate on our Roth conversion in retirement, right? I'm not here to say the Roth 401k is never the right answer, but it ends the planning. What are we doing? We have this great tax rate arbitrage opportunity in our retirement. Why do we want every last dollar in a Roth 401k? So many commentators are Roth 401k, Roth 401k, Roth 401k. Well, you're foregoing this, the possibility of a very low effective tax rate Roth conversion in retirement. What do you think about Roth conversions in retirement? And do you agree that they mean, generally speaking, a lot of working Americans should be maxing out those traditional retirement accounts? What do you think? Let me know in the comments below. Hope you enjoyed this video. If you did, please mash that like button and subscribe to my channel. I'll see you next time.